I think 3,000 on gold is a conservative number. Silver, I have raised my target from 60 to 75. The miners that go along with that, I think will get all the benefits of big moves in the metal prices. So I'm very bullish on both of the precious metals for sure. And in the bull market for the metals, silver does outpace gold almost always. So, on the way down, gold holds up better. Silver gets hit harder. On the way up, silver has a catch up.
2024 is shaping up to be one of the most profitable years ever for commodity traders. And this could be just the beginning. As of June 30th, gold is up 12.79% year to date, marking its best 6-month start since 2020. In Q2, gold bullion reached new all-time highs, closing at $2,326.75 on June 30th. Central bank buying continues to drive gold prices higher, with a significant shift in central bank reserves expected to continue. Anticipated increases in gold reserves and reductions in dollar reserves are likely to further boost gold prices. Silver also had a strong performance, closing Q2 at $29.14, its highest quarterly close since Q3 2012. This rise was supported by gold's breakout and global monetary expansion policies, with silver breaking above the critical $29.30 resistance level. Additionally, growth estimates for photovoltaic panel usage have been significantly revised upward, leading to silver demand outpacing supply. David Hunter, chief macro strategist at Contrarian Macro Advisors, remains bullish on precious metals. He continues to predict that gold will reach $3,000 this year, considering this a conservative estimate. For silver, he has raised his target from $60 to $75, a significant increase from the current levels of around $29 or $30, representing more than a doubling in price. Silver has been on a blistering run since October last year, rallying from just under $20 an ounce to a 12-year high of $32.50 an ounce this month, scoring an impressive gain of over 62% within such a short space of time. The last time silver prices broke above $32 an ounce, the precious metal went into trade at $50 an ounce in the space of 100 days. Long considered the poor man's gold, silver has become a valued mineral in its own right against the backdrop of escalating geopolitical tensions and the prospects of an easing monetary cycle. David believes that in a bull market, silver typically outpaces gold. During downturns, gold tends to hold up better while silver suffers more. However, on the upswing, silver catches up and outperforms gold. He added that once it becomes clear silver is in a big bull move, it can cover a lot of ground quickly. Before we jump into more content, consider subscribing and enabling notifications to stay updated with our latest uploads.
I think gold and silver, after a very long wait of years for silver, particularly gold's broken out and has tried to get to new highs several times in the last couple of years, but silver's way behind its all-time highs. It took a long time to get here, but I think gold and silver have begun big moves. I continue to say we'll see gold up at 3,000 this year, and I think that's conservative. I think, or I say pre-bust. So if the bust gets extended into the first quarter, then it might take a little longer. But pre-bust, I think 3,000 on gold is a conservative number. Silver, I have raised my target from 60 to 75. And that's a long ways away. I mean, we're down around 29 or thereabouts, 30. So it's much more than double. And the miners that go along with that, I think will get all the benefits of big moves in the metal prices. So I'm very bullish on both of the precious metals for sure. It could happen this year, or it could spill into the first quarter. I think it's pretty much, it's a pre-bust number. So it kind of, again, you're right. It's from here, say from 30 to 75 is a huge move. So I don't think it happens in 3 months, but if you get this thing going, silver has a history of once it becomes very clear that it's in a big bull move, it can cover a lot of ground in a hurry. So I would say certainly first quarter next year is a real possibility. It could, if things really get going here, it could happen before the end of the year. And if not all of it, certainly a lot of it, I think, does occur here in the next 5 months. And in the bull market for the metals, silver does outpace gold almost always. So On the way down, gold holds up better, silver gets hit harder. On the way up, silver has a catch up, I don't know where the silver gold silver ratio is right now. It was up over 90, I think, but I think you could see that down to somewhere near 40 or 45 in this move. So silver definitely looks like it's going to outpace gold, and gold's going to do pretty well itself. I think it's been frustrating for investors, because the metals woke up before the miners have, and then the miners look like they're starting to go, and then they have corrections again. I think it is a frustrating trade, but I think there's a lot to be bullish about going forward. I think this most recent consolidation is just about done, and I think from here you see some pretty fast moves.
As we look toward the latter half of 2024, the Federal Reserve's approach to interest rates remains a focal point for economists and investors alike. With the Fed maintaining its interest rate in the mid-5% amidst a backdrop of declining inflation, the real interest rate, the rate above inflation, has effectively been rising. Turning to the stock market, there's been much discussion about the narrow breadth of the current rally, driven predominantly by a few large-cap tech stocks or the Magnificent Seven stocks. In the week of July 15th to 19, the small-cap Russell 2000 index just posted the most powerful 5-day outperformance versus the large-cap S&P 500 index in at least 40 years. Russell. On the other side of a market bust, Hunter sees significant opportunities. He believes that capital preservation will become paramount to take advantage of post-bust opportunities. He predicts a significant cycle for commodities and industrials, particularly commodities, driven by inflation and increased demand outstripping supply by the late decade. For example, he predicts oil could drop to $30 during the bust, but then rise to $500 by late this decade or early next. Let's now turn our attention to the video again.
The thing I say is basically, two things. One, take advantage if you can, but don't get yourself overextended. Don't take risks that you're not comfortable with, because if you're wrong, you can pay a big price. So I just tell people you can hear the volatility in my scenario, and some people hear that and jump in options, and then the options expire, and they made a mistake. So I kind of lay out a scenario, and people just have to work within their own capabilities, their own risk tolerance, their own. Don't get out over your skis, because it's going to be punishing after this. And some people feel comfortable shorting. There'll be opportunities, obviously, to do that. Some people don't. Some people are good at options trading. Most people are not. I think people have to kind of if you're not comfortable, keep the scenario I lay out, the forecast I lay out, is really to give you a basis to work off of. The biggest thing I say is, in the end, just stay within your own capabilities, and understand that it's not going to happen precisely the way I lay it out. It can get extended. It can happen sooner or later. But it just gives you kind of a basis so that when it happens, you're not surprised and shocked and kind of frozen. We're coming up to a point where capital preservation will take precedence, as I just explained earlier in the interview. I'm not sure this is the point where you say that everybody has to make that decision themselves. There are returns, I think, still left in this market that are pretty sizable. But once we get to that point where it rolls over, capital preservation is first and foremost, because you want to preserve your wealth so that you have the ability to take advantage of the opportunities that will follow after the bust and after the bear market. And I will say the cycle that follows the bust is going to be very big for commodities and industrials, but particularly commodities. If inflation does what I think it's going to do, a lot of that's going to be driven by commodity prices going through the roof. And I won't lay out the reasons here, other than the fact that when you print that much money, you create demand, and it's going to outstrip the supply of most commodities by the time we get to the late this decade. So oil can go from 30 year. I'm predicting $30 in the bust next year, bottom of the bust. It can go from there to $500 by late this decade, early next. Gold, I am predicting $20,000 by late this decade, early next. Silver could be $500. So there's, but on the other hand, in the bust, if gold goes to 3,000 or higher, it could come back to say 2,000 or 2,100 or 2,200, somewhere in there, before it takes off after the bust. If silver goes to 75, it could give back 50% or more of it in the bust. So it's not a straight line, but there are some big opportunities following the bust.
The precious metals sector, prominently gold and silver, currently confronts notable challenges, with gold re-entering its previous consolidation range of $2,300 to $2,400 per ounce, and silver potentially slipping below its $29 support level. This arises from a strengthened US dollar, rising bond yields, and an increased preference for riskier assets due to post-pandemic recovery optimism. Despite imminent economic challenges, forward-thinking investors might find valuable opportunities in the potential growth of precious metals. Consequently, considerable attention will remain on gold and silver stocks, particularly those that balance foundational strength and growth potential. We want to hear from you. Feel free to leave your thoughts in the comments, give a thumbs up if you liked what you saw, and subscribe to stay connected with our ongoing exploration.